Hey, so in this video, I'm going to teach you about something really important for the potential return of your real estate property, and that is your exit cap rate. You probably heard of a cap rate in real estate. An exit cap rate is that projected or the expected cap rate that you hope to sell the property for in the future when you're going to exit or sell the property. And what we're going to do here is I'm going to walk through just some of the highlights to get us all on the same page on some key terms and definitions in this blog post that we put together on exit cap rates. And then really the meat of what I want to show you here is I'm going to jump into one of our real estate financial models. We've got a number of different models. I'm going to look at our multifamily apartment complex model and just take a look at, hey, what happens to our potential return? What happens to our IR on a property when we look at different exit cap rates and just see how much of an impact this can really have on your property. With that, let me just make sure we're all on the same page on a couple of items here. So let's just get some key definitions. So your cap rate, first of all, what is your cap rate? It's a ratio used to estimate the potential return on an investment property, and it's calculated by dividing the property's net operating income. So you've got net operating income divided by the current market value. And we can see an example here. If a property generates $10,000 per year in net income and its market value is $100,000, the cap rate would be 10%, right? So if you are looking to acquire a property, you probably know you're acquiring it at a certain cap rate, right? And so then the question is, and it's got to be part of your model to determine whether you think it's a good investment, ultimately, your model needs to have an exit cap rate. What do we think the cap rate's going to be when, in the future, we sell the property? And so in order to do that, we're going to need to estimate our future net operating income divided by the expected selling price in the future. Now, exit cap rate may also be known as a terminal cap rate. You can keep that in mind. And you may have heard the going in cap rate. So this term going in cap rate is the cap rate that you probably used when you purchased the property, right? And so let's just dive into our template here. And I'm going to put a link to this model in the description of the video below. This one is our multifamily kind of acquisition model. So it would allow you to acquire a multifamily property. You could rent it, model renovations, and then ultimately a sale of the property and see potential returns on that. And we have a number of other real estate templates as well, and we'll link to those down in the description as well. But this is what I wanted to really point out to you. So we've already got a whole bunch of assumptions built into the model. I'm not going to go through those. We're just going to assume those are reasonable for our purposes here. And we're going to say, okay, we're going to sell this property in year 10 of the model. And at that point, there'll be net operating income of $1.5 million. And we are assuming an exit cap rate of 5%, because maybe we bought it at a 5% cap rate. Let's say we bought the property at 5% cap rate, and we want to assume, or we're hoping that we'll have the same exit cap rate. And so based on that, we're going to have gross sale proceeds of $30 million. At that point, we expect to have debt of $11 million. And so net proceeds of $19 million. Our total equity investment was $4.5 million, and we had these distributions to the investors throughout the life of the property. And so based on all of these assumptions and that 5% cap rate, we can see a IR after the sale of property of 25.1%. Now, if you're going to look at this exit cap rate and say, you know what, we bought the property at kind of a unique time in the market and exit cap rates were historically low. And so we want to assume, to give ourselves a margin of safety on this deal, we want to assume that our exit cap rate is actually going to be 7%. So if we do that, what does that do? Let's just look at that real quick. So gross sale proceeds go to $21 million. Look at that again. So if we were at 5%, we're at $30 million. At 7% cap, $21 million. So a $9 million difference. Now, I think that's almost more striking to me is the dollar amount difference that 2% change in the exit cap rate creates. You'll also see that the IR went from 25% down to 19%. Your exit cap rate is a significant assumption for your financial model. And I think the point here is just to understand what that is and understand that it is you're making a big assumption. Again, to be conservative and give your deal a margin of safety, I think it would make sense to, especially if your going in cap rate is historically low, then make sure that in your model that the deal still makes sense, assuming exit cap rates are more in line with historical norms. And you may even want to kind of stress test the deal and say, okay, what if this cap rate goes to 10%? And let's just see what happens. Okay, so at 10%, we can see our IRR is more than cut in half. Proceeds are significantly lower. So anyway, this template and tool and all of our real estate pro formas can give you this kind of scenario tab, and it's called our input distributions tab, but it can help you think through these scenarios and just see what's an exit cap rate or that sale cap rate really going to do to my deal? And so I hope that's been helpful. If you have any questions as you go, reach out to us at support@projectionhub.com or leave a comment in the comment section of the video below. We'd love to hear from you and do our best to help. Thanks.